Thank you for joining us for another investment manager presentation in our Quoted Data Around the World webinar series. Today I'm joined by James Goldstone, who manages the UK equity share portfolio of Invesco Select Trust. James will provide an overview of the company and will discuss the team's approach to portfolio construction. So with no further ado, I'll hand over to James.
Thank you, David, and thank you everybody for your time. So I'm going to start with some scene setting. Firstly, I'm going to introduce myself and Kieran Mallon, who is the joint manager of the UK Select portfolio alongside me. I'm then going to introduce the trust itself, which has an unusual but what we think is very attractive structure. I'm then going to touch briefly on our approach to investing. Then I'm going to get into the portfolio and talk about how it's positioned before talking about the state of play in the broader UK equity market today, and then pulling it all together with some concluding thoughts. So to start with the introduction to Kieran and me, there's a photo of each of us on this page. I'm not going to dwell on this really, but suffice to say, all of that text is suggesting that Kieran and I have got different backgrounds. In the time that we've managed money separately, we've done it perhaps with slightly different emphasis on certain aspects of fund management, but with a consistency of approach. And as Kieran said when we first came together almost 2 years ago, you know, we do talk the same language, different emphasis, but we talk the same language. And what we found is that during that period that we've jointly managed funds, we're actually really complementary. And of course, at risk of stating the obvious, the fact there are two of us, we can cover more ground. It is important, though, I think, for people to know that the way that we've set the process up is that it's a joint process. It's every decision is a joint decision, and that means that we're jointly accountable for every single position in the portfolio. So I said I wanted to explain the structure of Select Trust because it is slightly unusual, but as I said earlier, we think it's very attractive. Select Trust has a total asset under management of about £200 million, which is split across 4 different share classes, each with a different objective. There's the ability to switch between share classes without triggering a disposal for CGT. And we think that that's a key differentiator. Kieran and I run just the UK equity share portfolio, which is about 150 million of that net asset value. And that's what I'm going to be talking about today. The second important bit of scene setting is around income. The UK share class is in the income sector. It pays a quarterly dividend, and the trading yield on the shares today is about 3.8%. As well as the 4 share classes, another unusual feature of Select is that the board can supplement dividends from capital. And for the UK share class, they've done that every year since 2016. So this has provided a consistency of dividends to shareholders, which can be reassuring in periods of volatility and where the dividends received from the companies in the portfolio might be depressed. Of course, we saw that in 2020 in the midst of COVID, there were very widespread dividend cuts across the market. Nevertheless, the dividend paid to shareholders in the UK share class grew year on year, even in that year. So topping up from capital, smooths the dividend, and also it allows Kieran and me the flexibility to manage the portfolio on a total return basis and try to generate returns both from income and from capital. So the objective of the trust and the board's approach to dividends have enabled us to construct a portfolio that we think is balanced in a number of ways. So to bring that to life, on the left-hand side of this slide, we hold shares in companies like BAT and Vodafone, lower growth companies, the ones that pay significant dividends today. And then we also hold companies that might appear on the right-hand side of this slide, like, for example, Bunzl and maybe Ashtead, which are reinvesting to deliver meaningful growth in both capital and dividends over time. And so what we think we've constructed a balanced portfolio of companies with different attributes that can deliver both income today and capital and income growth in the future. And we're using that flexibility to focus on what we think is most important. We've worked out over our time managing money, both separately and last couple of years together, what we think makes a good company, what makes a good investment, what makes a good portfolio. And that's what we've put together for this trust, a relatively concentrated but balanced portfolio of our very best ideas that's capable of delivering attractive returns, whatever the weather. By good company, good investment, we mean companies that make good returns on shareholders' money with a credible management team that we trust to allocate shareholders' capital appropriately. And we mean companies with the right balance sheet whose shares are attractively valued. So with all of that scene setting out of the way, if we go to the next slide, I'm going to start to talk now about the portfolio. And what we've done on this slide is to just break the portfolio down, the holdings in the portfolio down into 5 broad themes to give an idea of the types of exposure that we have. I think it's just really important to say that this is an output of the investment process rather than a framework or part of the investment process, or the sort of thing that we're thinking about when we're managing the portfolio. We're not thematic investors, but we have found in the past that it's helpful to investors to see the sorts of exposures that exist in the fund. So if we go from left to right, the first box there is UK domestic, and you can see that at the bottom that represents about 27% of the portfolio. All of these numbers are on an unlevered basis. The next one is international value, and you can see there that represents about 28% of the portfolio. The next one is international growth, that's about 24%. There's then what we've called recovery, which at the moment, as we're still coming out of the sort of overhang of COVID, is pretty focused around things that were hit hardest by lockdown. But over time, we think we'll always want some exposure to companies that are recovering from either something that's company specific or whatever the most recent crisis has been. And now on the right hand side, we've got what we call transformers, which about 12% today. And when we say a transformer, we're talking about something that is considered by the market to be one thing, but there's a good deal of change which perhaps hasn't been fully recognised yet, that we think will become clear over time, and it will be seen that the company has transformed itself from one thing to another, and that transformation will in theory command a higher rating. So I'm just going to talk about one company from each of those 5 boxes, just to bring that to life a bit. So in the first box, UK domestic, PRS REIT. So this is a portfolio of about 5,000 family houses in the regions in the UK. It's been put together over the last 4 or 5 years. It's virtually fully occupied. It's very diversified by development, and obviously because there are 5,000 houses, by tenant. And we think that serves to mitigate the risk. It pays a very attractive yield, and we think that the current valuation represents really good value against the net assets of the REIT. The next box, international value. Hiscox is an international insurance and reinsurance business. Its history is that it was a syndicate at Lloyd's, but it spent more than a decade investing heavily into some really high quality branded businesses that command a greater level of loyalty and therefore have a sort of greater longevity of revenue and profit. And one of those in particular, which is in the US, a US SME, small and medium enterprise focused business, they've been building for about 10 years. They're deliberately reinvesting all the profits at the moment back into marketing to continue to grow the business. It currently has a very, very modest market share, but we think it's doing something different. We think that the current rates of growth, which are about 20%, are sustainable, and we see them building, really meaningful business in a growing market. We think that because there's no profit being generated by that division at the moment, there are no earnings being capitalized into the share price. We really just don't think that there's any value being ascribed to it at all, and therefore we think that's an out-and-out value situation. The next box, international growth. We hold shares in Ashtead. I mentioned Ashtead earlier. It's an construction equipment rental business. There's a big change going on in that marketplace as construction companies are going from owning their own equipment increasingly to renting the equipment. There are lots of benefits to that. They get newer equipment, they get the flexibility about the specific equipment that they need. The utilization of the equipment can be higher because when they're owned by the construction companies, they're rarely used all the time. There are, of course, some environmental benefits to that. It's much more efficient for the economy as a whole to have something that's fully utilized. And because of Ashtead's expertise, it's well maintained. Because of Ashtead's investment in technology, it can be there on the right day, at the right time, and it can be taken away when it's not being used. And so, this delivers huge efficiency to the customer base and great benefits to Ashtead. They've invested very heavily. They continue to invest heavily. It's a growth market, and they're taking share of that market. And so we think that's an out-and-out growth story, and one that we're really keen on. In recovery, I said earlier that by recovery at the moment, we're really talking about things that are recovering from COVID. One of those is DFS, which is a brand you're probably familiar with if you're based in the UK, the furniture retailer. DFS over a number of years has been building market share. It now has a very dominant share, mid 30% share of the UK sofa market. It has lots of benefits as a result of that. It has bargaining power when it's talking to its suppliers. It has bargaining power when it's talking to its landlords. And it has the wherewithal to invest both in the physical sides, which are absolutely key to furniture retail for people to sit on the sofa, as well as capacity to invest in an online offer. And most sales now, people look online, they browse online, they might go to a showroom, sit on the sofa, then they want perhaps go back and complete the purchase online. And being able to invest in both of those channels at a rate above its competitor set, who in many cases are struggling, is really driving market share growth for DFS. And so, we think it's got great prospects. Because of COVID, the shares were hit very, very hard. The valuation's modest. We think there's a long way, a lot of recovery ahead, both in earnings and in share price terms. And then finally, in the transformer box, Next, we all know probably, again, if we're based in the UK, Next, and we think of it predominantly as a bricks and mortar retailer. But actually over half of Next business now is either online or finance related or overseas. And in the online business, they're not just selling their own product. They've effectively built a very high tech platform within the Next corporate structure, and relying upon and maximizing the opportunity that's presented by the Next logistics infrastructure. And there are a number of third-party retailers who have now signed agreements with Next. And in many cases, Next in return have been able to take an equity stake in that third-party brand, where Next take all of the very difficult logistics, website hosting, payments. There's a sort of menu of services that Next can offer, but in the most extreme cases, the brand exists just as a brand, and Next do all of the fulfillment and all of the transactional side. And we just don't think that the market has fully appreciated that yet. And Next is seen predominantly still as just a traditional retailer. And so we think that over time, as that becomes clear and the business grows accordingly, that there's real upside to the valuation. So hopefully that gives a sense of how we're positioned and has slightly brought to life some of those themes. On the next slide, there's the top 20, the top 20 holdings in the trust. You'll see it's a relatively concentrated portfolio. We want our best ideas to be represented at the top of the list and to really make a difference. And then on slide 11, you can see the more traditional view of the portfolio by sector. And the biggest overweights are utilities and consumer discretionary, and the biggest underweights are consumer staples and financials. Now, I talked about income earlier. This pie chart here shows the breakdown of the forecast dividend for the portfolio. The forecast yield, so just to be very clear, this is on the portfolio, not on the shares. It's before the impact of gearing. but over the next 12 months, the forecast yield is 3.4%. It's well covered, and as hopefully this pie chart shows, it's well diversified. The next slide shows the equivalent for the Ftse all-share index. So the forecast yield for the index today is about 3.6%. We think that the 3.4% is very competitive, and as I said earlier, that's before gearing, and that's before any decision by the board as to whether to top that up from capital. So we think there's a compelling income story here from a well covered and well diversified dividend flow. And then finally, just on slide 14, you can see the market cap breakdown, or the breakdown of the portfolio by index. It's a liquid portfolio, it's weighted to large cap, but it's also a portfolio that's taking advantage of the size of the trust and the closed-ended structure to invest in a number of less liquid shares in smaller companies where Kieran and I have very high conviction. So we told you how the trust is structured and how we think about investing and how the portfolio is positioned today. But how's that worked? Well, both recent and long-term performance have been strong, outperforming the Ftse all-share by some margin. However, we appreciate that the UK faces lots of competition from other stock markets around the world, and so I thought I'd finish off by just trying to persuade you that despite rumours to the contrary, the UK stock market isn't dead. And so on the next slide, this is perhaps where the rumours emanate. Really, ever since the referendum on the UK's departure from the European Union, the Ftse all-share index has quite materially underperformed its international peers, developed markets indices. And I think there's a perception that that's down perhaps entirely or almost entirely, certainly relative to the US market, to the fact that there's no tech sector of note in the UK. But if you look at the next slide, you can see that actually, whilst I think there is something in that tech argument, it's only part of the explanation. The dark blue lines on this slide are just 4 examples of international businesses that we hold shares in the trust, that happen to be listed in the UK, and that since Brexit, which is where all of these slides start, have underperformed their US peer group, which is shown in light blue. And these are just a few examples, but there are many more in the portfolio. And in our experience, these sorts of situations do tend to resolve themselves over time, either by a re-rating or, if they persist for long enough, via M&A. And you can see in the bottom right-hand slide that there's one example here, which is a telecoms company. We've been asked by compliance to anonymise it, but a UK listed international telecommunications business, which had dramatically underperformed its US peer group, and that's just started to narrow. And in fact, that has coincided with this talk of some consolidation within some of its markets. So, we do think that there's some hope, and hope of a re-rating, and if it happens, it's for a pretty depressed level, so that could make the UK market a good place to be. On the next slide, we're looking at another way. Here we're looking at the price to book valuation of each of these markets or groups of markets relative to their own 20-year median. So what we're saying here is that the valuation, the total market cap of the market compared to its book or net balance sheet value today, compared to how cheap or expensive it's been relative to that value over the long term. And the UK, alongside Japan, is still at a discount to its 20-year average. That discount has narrowed in the last, I would say, 6 months. It was wider, but it's still at a discount. And you can see that there are a number of markets where they're trading at very big premia to their 20-year average. Now, this is just relative to the book value. If you also consider relative the valuation today, the market cap today, relative to a theoretical fair value based on the profits that those book values generate, you get a very similar picture. So I just think this is an alternative way to look at the performance of the UK market and the valuation of the UK market relative to history. And once again, it does make it look attractive. And then on the next slide, and this almost remakes the point that it's not just about the tech sector. Again, we've got now 11 sectors where the pink triangles are the UK market, the blue dots are the US market, and this is how many standard deviations away from their 20-year average the valuation of each of those sectors in those two markets sit today. And again, to remake the point that this isn't just about the tech sector, in only 1 out of those 11 cases is the UK sector more expensive relative to its history than the US market, the US equivalent sector, and that's in healthcare. In every other case, and in the market overall on the left-hand side, there's a very, very big gap opened up in that valuation relative to history. So we do think there is value in the UK market. So one final point I just want to make while we're talking about the market and the portfolio is just about gold. I didn't dwell on the top 20, but if you looked really quickly, you'd have seen that in the top 20 we've got a position in both Barrick and Newmont, which are two North American gold and other precious metals mining companies. So I did think it was worth, given this is a UK portfolio, just touching on the reasons for that. And what you can see here is a slide on gold. This shows the correlation, and this is over about 12 years, so it's a relatively long period, between the gold price in dark blue and the value of the 5-year TIPS, which is the Treasury Inflation Index security. And the point that this is making is that gold tends to be correlated with partly inflation, but really with real interest rates, US real interest rates. That's certainly been the case historically, and we think it will be the case going forwards. Now, as well as providing some diversification in periods of extreme volatility, and we've seen that yet again recently. I think that's another really interesting attribute of gold, that when there's panic in the market, the gold price and therefore the companies that mine gold tend to go up. They don't just fall less than the market, they tend to go up when the market goes down a lot in those tails. That's another interesting attribute. But this one, the one that we're showing here, is really the sort of long-term top-down reason for gold being an attractive asset. And we've seen before the Ukraine conflict, as we recovered from COVID, much higher levels of inflation than we've become accustomed to. Still with interest rates, and that's both policy rates set by the central banks and also market rates of interest at much lower levels than would ordinarily be required to combat that inflation. We think, given the amount of debt in the world and the additional debt that's been accumulated in order to drive the recovery from COVID, that is likely to remain the case, and therefore even before the Ukraine conflict, we thought that interest rates were likely to be increasingly negative into the future. With all of the inflation in commodities, particularly the oil price, and the likely knock-on spillover inflation into the economy, if that was true before, it's certainly true now. And so we think that the gold is a very attractive asset, and in those two companies, we've selected what we think really are the best in class. They're the most diversified, they're the biggest, they've got the most scale, most ability to diversify by geography and by asset. They've got very low cost bases, and therefore they're least exposed to the gold price. There is exposure, but they're not exposed to declines in the gold price, which will happen from time to time. They'll remain profitable, they continue to generate cash flow. They've got net cash balance sheets, so very, very conservative financing structures. And when you put all of that together, that results in really attractive free cash flow yields, a big proportion of which are being returned to shareholders. And all of that is at the current gold price. So we're not reliant on gold making further progress in order for that investment case to hold water. It's an absolutely compelling investment case. It was compelling when we invested at lower gold prices, and it's certainly compelling today at the current gold price. If there is upside to gold, it'll get even better, but we're not reliant on that. And so I just thought it was worth just singling those two out, because they probably are genuine differentiators for this portfolio when compared to its peer group. So to summarise, clearly we've just lurched from one crisis with COVID right into another with the war in Ukraine, and that is now dominating headlines and causing extreme volatility in markets. However, the companies that we hold in the portfolio, they came through operationally through the COVID disruption on the whole with flying colours. And indeed the COVID disruption probably isn't yet at an end. Some of them are still trying to normalise for what they've lived with for the last 2 years, and are now facing the consequences of war in Ukraine and all of the disruption and all of the additional supply chain challenges and the inflation in commodities that's created. But I suppose we're reassured that they've been tested once. We've had plenty of opportunity to see how they fared, and on the whole they've fared very well. So we've got no view on how long this current situation is likely to last, and we're not in the business really of making forecasts about the extent of it or how and when it might be resolved. But we do believe, from everything we've seen in the last couple of years and from what we've learned from talking to the companies in the short period that the latest episode has been underway, that they are on the whole positioned to at least withstand it, and in some cases, in fact, to benefit, because the stronger companies, very often when there's disruption, it's the weaker competitors that suffer the most, and it can be an opportunity for some of the better run, better managed businesses with scale to take further market share. So we think we've got a well-balanced portfolio of actively positioned and attractively valued companies that generate a good, well-diversified stream of income that's well covered by earnings, and notwithstanding the extreme uncertainty and volatility, we genuinely believe that we're really well positioned for the future. So firstly, the performance, because we talked about performance over the discrete periods going back 10 years, and then secondly, because I've referred to the performance of some other indices. On the next slide, we've got the performance over rolling 5 years of those the Ftse All-Share and those 3 international indices. So with that, I'm going to say thank you very much for your time. I hope it's been of some use, and goodbye.
Thanks, James. Thank you very much, James. It's very interesting and useful talk through of Investment Select's UK equity share portfolio. I'd like to thank everybody who dialed in to listen to this recording, and remind you to look out for the other recordings in our Around the World webinar series, which are available in the videos section of our QuotedData.com website or via our YouTube channel. Watch out for more videos to come. Thank you.